What if I told you that the difference between traders who make it and traders who don't has almost nothing to do with their strategy, and almost everything to do with whether they have a plan they actually follow? What if the reason you're still struggling isn't because you need to learn one more indicator or find one more pattern, but because you've never built a trading plan that's truly impossible to deviate from? Here's the promise I'm making you today. By the end of this video, you'll have a framework for creating a trading plan so clear, so specific, so bulletproof that following it becomes easier than breaking it. And when you can finally do that, when you can plan the trade and trade the plan with perfect consistency, everything changes. Let's build that plan right now. The first decision in your trading plan is what you're trading and when you're trading it. This isn't arbitrary. According to research on expertise development, specialists outperform generalists in complex domains by a significant margin. You need to pick one market and one primary time frame and become an absolute expert in how that specific combination behaves. Are you trading stocks, forex, futures, or crypto? Each market has different characteristics, different volatility patterns, different liquidity profiles. Pick one based on when you can actually be available to trade and what capital you have access to. Then choose your time frame. Are you a day trader watching 5-minute charts, a swing trader using daily charts, or a position trader looking at weekly time frames? This choice should align with your lifestyle. If you have a full-time job, day trading is probably unrealistic. If you can watch markets during the day, shorter time frames become viable. Research published in the Journal of Finance shows that traders who stick to one time frame consistently outperform those who jump between time frames by an average of 4.3% annually. Why? Because each time frame has its own rhythm, its own noise level, its own patterns. Mastering one is hard enough. Mastering multiple simultaneously is nearly impossible. Your plan needs to be explicit here. Write down exactly what you're trading and exactly what time frame you're using. Not, I trade stocks on various time frames depending on what looks good. That's not a plan. That's a recipe for inconsistency. Instead, I trade large cap stocks with daily average volume above 5 million shares, using the daily chart as my primary time frame for analysis and the 1-hour chart for entry timing. See the difference? One is vague, one is executable. Your trading plan should be so specific that someone else could pick it up and trade it exactly as you would. Now we get to the heart of your plan. What makes you take a trade? This is where most traders fail because they rely on subjective judgment rather than objective criteria. Your entry rules need to be measurable and specific enough that you can look at a chart and know with certainty whether your criteria are met or not. According to research on decision-making under uncertainty, removing subjective interpretation from trading rules increases execution consistency by over 60%. Let's build an example entry rule that's actually actionable. Instead of I trade breakouts, your rule might be, I enter long when price closes above the 20-day high on volume that exceeds 1.5 times the 20-day average volume, with the RSI between 40 and 70, and only when the broader market index is trading above its 50-day moving average. Every part of that is measurable. You can look at any chart and determine in 30 seconds whether those conditions are met. There's no room for interpretation or emotion. Your entry criteria should also include what you're not going to trade. This is equally important. Maybe you won't take any trade in the first 30 minutes after market open because volatility is too high. Maybe you won't trade during earnings weeks. Maybe you won't enter a position on Friday if your holding period extends into Monday. These exclusion rules protect you from trades that historically haven't worked for your strategy. Research on behavioral finance shows that traders who explicitly define what not to trade show 37% fewer impulsive trades than those who only define what to trade. The key is that your entry criteria must be tested. You can't just make up rules that sound good. You need to have back-tested these criteria over at least 100 historical examples and confirmed that they produce positive expectancy. If you haven't done this work, you don't have a trading plan yet. You have a guess. The testing is what transforms a guess into a plan worth following. Your stop loss isn't optional, and it isn't flexible. The moment you enter a trade, you must know exactly where you're getting out if you're wrong, and that level must be set in your system as an actual order, not just a mental note. According to a study analyzing over 100,000 retail trades, traders who used hard stop-loss orders had 41% smaller average losses than traders who used mental stops. Why? Because mental stops can be moved, rationalized away, or ignored when fear kicks in. Hard stops execute automatically. Your plan needs to specify how you determine stop-loss placement. Some traders use a percentage, risking 1% of their account on every trade. Others use technical levels, placing stops just beyond recent support or resistance. Others use volatility-based stops using the ATR indicator. What matters isn't which method you choose, but that you choose one method and apply it consistently to every single trade. Your rule might be, I place my stop loss at a level that risks exactly 1% of my account equity, positioning it below the most recent swing low on the 1-hour chart, but never closer than 1 ATR from my entry. You also need a rule about stop loss adjustment. For most traders starting out, the best rule is simple. Never move your stop loss away from your entry. You can trail it to lock in profits once the trade is well in your favor, but you cannot give a losing trade more room to work. The moment you start moving stops to avoid losses, you've abandoned your plan and you're trading on hope. Research shows that traders who move stops away from entry increase their average loss size by over 200%. Your stop loss is there to protect your capital. Let it do its job. Position sizing is where your trading plan either protects you or destroys you. You need a mathematical formula that determines exactly how many shares or contracts you take on every trade based on your account size and the distance to your stop loss. The most common approach, and the one backed by decades of research, is to risk a fixed percentage of your account on each trade. Most professional traders risk between 0.5 and 2% per trade. Here's the formula. Take your account size, multiply by your risk percentage, then divide by the distance from your entry to your stop loss. If you have a $10,000 account, you're risking 1%, that's $100 per trade. If your entry is $50 and your stop is $48, that's a $2 risk per share. $100 divided by $2 equals 50 shares. That's your position size. This formula ensures that every trade risks the same dollar amount relative to your account regardless of the stock price or stop distance. Your plan must include maximum exposure rules. Maybe you never risk more than 5% of your account across all open positions combined. Maybe you never hold more than 3 positions simultaneously. These rules prevent you from getting over-leveraged during periods when multiple trades look attractive. According to research on risk management, traders with explicit position limits show 53% lower maximum drawdowns than traders without such limits. The rules protect you from yourself when opportunity appears abundant. Your profit target strategy needs to be just as clearly defined as your entry and stop loss. Some traders use fixed risk-reward ratios, always targeting 2 times their risk or 3 times their risk. Others use technical targets based on measured moves or resistance levels. Still others use trailing stops that lock in profits while letting winners run. What matters is consistency in application. Let's say you use a 2-to-1 risk-reward ratio as your minimum target. Your rule might be, I place my initial profit target at a level that's twice the distance from my entry to my stop loss. If price reaches this target, I exit 50% of my position and move my stop to break even on the remainder, then trail that stop using the 20-period moving average on the 1-hour chart. This gives you a systematic way to take some profit while leaving room for larger wins. Research on trading outcomes shows that traders with predetermined exit rules outperform those making discretionary exit decisions by an average of 6.8% annually. Why? Because in the moment, when you're watching a profitable trade, every psychological force in your brain is pushing you to either exit too early out of fear or hold too long out of greed. Your predetermined rule cuts through all of that noise. You set your target when you were thinking clearly, before money was on the line. Trust that version of yourself over the emotional version watching the position move. You should also have a time stop rule. If your trade hasn't hit your target or your stop within a certain number of days or bars, you exit anyway. This prevents capital from being tied up in dead positions. Maybe your rule is, if the trade hasn't reached my target within 5 trading days, I exit at market close on day 5 regardless of profit or loss. This forces you to constantly put your capital in the most productive positions rather than hoping dead trades will eventually work. Here's what makes a plan impossible to lose with, and I need to be precise about what I mean by that phrase. I don't mean you won't have losing trades. You absolutely will. I mean you cannot lose your account, you cannot blow up, You cannot experience catastrophic drawdown if you follow your plan perfectly. A plan built on 1% risk per trade, clear entries, hard stops, and tested criteria means that even a string of 10 consecutive losses only costs you 10% of your account. That's survivable. That's recoverable. That's impossible to lose with in the catastrophic sense. According to research tracking trader longevity, traders who maintain consistent risk management and rule adherence have a 91% probability of still trading profitably after 3 years. Traders without systematic plans have only a 7% 3-year survival rate. The plan isn't what makes you money in the short term. The plan is what keeps you in the game long enough for your edge to manifest over hundreds of trades. Your complete trading plan should fit on one page. At the top, your market and time frame. Below that, your exact entry criteria with no subjective language. Then your stop-loss methodology, your position sizing formula, your profit target strategy, and your trade management rules. Print this out. Keep it next to your computer. Before every trade, verify that all criteria are met. After every trade, journal whether you followed the plan perfectly. Your only job is execution. The plan does everything else. Remember, the best traders in the world aren't the ones who predict markets correctly most often. They're the ones who execute their plan most consistently. Plan the trade by defining every element before you risk a dollar. Trade the plan by following those definitions without deviation. Do this over hundreds of trades, and the statistics take care of themselves. That's not motivation. That's mathematics. Build your plan today, test it thoroughly, then trade it with perfect consistency. That's the only path that works.